You are on a mute, Jyotsna.
Sorry. Can you all
Okay.
hear me?
Yes.
Okay. So good morning and welcome all to the 18th International Tax Conference Phase 2, Phase 1 of which was held in September 2021. And this Phase 2 is going to comprise of two sessions. Session 1 will have a panel discussion on salient features of global minimum tax. The session moderator is Ms. Neha Malhotra, Director, Nangya Anderson India Private Limited. The panelists are Ms. Shilpa Udeshi, who's a chartered accountant, Ms. Sarika Malhotra, Indian Tax Manager, Cargill India Private Limited. Request you all to post your questions in the question and answer box, which will be taken up at the end of the session. So I hand over the stage to Ms. Neha. Thank you.
Thank you, Jyotsna, and thank you all for joining us for this International Tax Conference. And I am really elated to discuss this important topic of global minimum tax. So we can say that this is one of the key points of development in an international tax framework. So I have with me Sarika and Shilpa. Let's have a good deliberation on various aspects. We plan to discuss salient features, various uh, issues that we think will be there in implementation. So to give you a little background, over 141 countries of OECD inclusive framework have developed a two-pillar approach to address the nexus and profit attribution challenge, which they are addressing through pillar 1 and the global minimum tax rules through pillar 2. So on 20th December, we witnessed a key point in this development. So GMT is essentially aimed at quelling the shifting of profits by multinational enterprises to low or no tax jurisdictions by eliminating the extreme tax competition amongst countries. So now we can say that the governments are holding other governments to certain standards because we see that certain countries are going too low in terms of their corporate tax rate, and certain countries have to maintain a bare minimum corporate tax rate for their economic development. So GMT is going to remove the corporate tax as a factor in countries' competition amongst each other for attracting investment. And as a byproduct, MNEs will have a more transparent, mechanical, and predictable rules with a level playing field for all. This will also reduce the incentive for MNEs to shift profits to low or no tax jurisdictions. And OECD has stated that we can expect a increase in revenue, an additional $150 billion of revenue from this global minimum tax rules. So what has come are the globe model rules. So when you say model rules, it is not a law which has to be mandatorily followed by every country, which is a part of this development because 140 countries have agreed that we will be part of this inclusive framework development. But they don't have to automatically start reducing their corporate tax rates. They have to change their domestic law to comply with and to change the domestic law in a manner which is compliant with the model rules framed by the OECD. And so who is impacted? The multinational groups who have presence world over. But these are not every multinational groups. These are only the large multinational groups with consolidated global revenue of at least 750 million euros. So these set of multinational entities will now have to maintain a third set of books for pillar 2 calculation purposes because this calculation is complex enough because it calls for certain tax adjustments, certain accounting adjustments to arrive at the global income that is liable to a minimum effective tax rate of 15%. So what is the impact? So these companies are impacted by this change. So it doesn't take away the country's prerogative to set its corporate tax rate. But if companies shift profits to low or no tax jurisdiction, then their country of residence would get the right to top up their taxes to the agreed global minimum tax rate of 15%. Let me try and explain this with the help of a formula. Just one second. I'll share the slide here. Sorry, there is some technical issue here. So this formula requires you to requires every multinational entity to compute their, unable to move the slides. Okay, yeah. I hope everyone can see the formula here. So there are various steps involved in computing your top-up tax that the multinational enterprise will have to bear, the effective tax rate globally. So first you have to compute your globe income, which is calculated for each of the jurisdictions, and the financial profits are adjusted with some tax adjustments and some accounting adjustments are made. So you arrive at your globe income. Then you have to compute your adjusted covered taxes. So what are these taxes that will be used? It will be the direct taxes. Indirect taxes are out of the purview of this. So any tax that is imposed on an entity's income or profit, or in lieu of any of generally applicable income tax, those will be covered as adjusted taxes. These are further adjusted for deferred tax expenses. I'm not going into the details on all the adjustments because then it'll become too complicated. So we are restricting it to the basic formula. So you arrive at your adjusted cover taxes, the which will let you achieve the jurisdictional effective tax rate. That is, adjusted covered taxes divided by the global income will give you the percentage of jurisdictional effective tax rate. So what is the effective tax rate being paid by the jurisdictions? And this will then help you achieve the top-up tax percentage. So there is a minimum ETR that we know that there is a 15% of minimum effective tax rate that a jurisdiction should bear. And if the jurisdictional level effective tax rate is lower than that, then there will be a difference which will be called the top-up tax percentage. This top-up tax percentage will be multiplied by the excess profits to arrive at the top-up tax amount that has to be borne by the ultimate parent entity, because here the allocation of this top-up tax will be done to the ultimate parent entity, and the ultimate parent entity who has complied with these rules and has put in place an income inclusion rule will pay the taxes accordingly. And in case there is no income inclusion rule at the level of the ultimate parent entity, then the UTPR will kick in, which is a backstop mechanism to give the taxing rights to the next level parent entity. The effective tax rate we all know is calculated first jurisdictional wise, and then the allocation is done first to the parent entity. There are definitely some de minimis exclusions for smaller multinational groups with global revenue below 10 million and profits below 1 million euros. Those will remain out of the purview of this taxation. And I just want to stop sharing this event. We can maybe keep it in the background. The formula can remain in the background. So all this has to change country wise. So each country will have to make a change to comply with this model rule. EU is the front runner. It issued directives within 2 days of OECD issuing the model rules. And they, however, made two small changes while complying with this rule to comply with their EU law requirement, because they say that there has to be a level playing field for all the entities. So they will have to make two changes, is what they said while bringing this change. And they enlarged the scope to include all large domestic groups. That is, even the companies who are placed only in EU region are in the purview of this taxation. And they have given a right to each of the EU member countries to increase their domestic tax rate so that they can levy a domestic top-up tax, which means that the top-up tax can be charged locally and not at the parent level entity. So the countries will have the right to tax that additional amount within the country so that there is no leakage of revenue for that member country of EU. So this is the change that EU brought while bringing in the global norms. Similarly, HMRC has also issued a consultation paper, but they have stated that they will remain as closely to the OECD model rules as possible. And now we have more than 100 other countries who are going to bring this change. And this change could take different forms. It could be a domestic top-up tax like EU. It could be an income inclusion rule. It could be a UTPR. It could be a minimum alternate tax, or it could even mean a withdrawal of certain tax incentives. So we don't know what kind of change may happen at various country levels. So I think since each country will adopt a modified version of the global model rules, managing tax compliance for a global organization which is spread across the world will be paramount. So taking the discussion further and understanding the perspective of my panel members, Shilpa, I understand that it is not mandatory for
Excuse
everyone.
me, Neha ma'am, shall I stop the sharing?
Yes, you can shop.
Okay.
Thank you. So, repeating my question, Shilpa, we understand that it is not mandatory for every country to apply the globe rules. So, what happens if a country chooses that I don't want to apply this global model? Shilpa, we can't hear you.
Ma'am, you're muted, I think.
Maybe she can log out and log in again.
No, you're not audible, Shilpa.
I can hear you now. Sorry.
We can also hear you now.
Perfect. I had some network issues, so good
No
it
problem,
got sorted at the right moment.
Yeah.
You may want to repeat your question. I missed it completely.
No problem. So, Shilpa, the thing is that we know that it is not mandatory for each of the countries to apply the globe rules. So, what happens if a country says that I don't want to apply these global model rules? Though I was a part of the inclusive framework, but I choose not to apply because it is not mandatory.
Sure. So, if we can look at this from a country perspective. Okay, so if one really sees if a country does not apply the globe rules, it will be the next entity in the group, the UTPR, the under tax payment rule will trigger in, and the other entity would get the right to apply the globe rules. So let us take, for example, you have an ultimate parent entity, say in a tax haven jurisdiction or any other jurisdiction which doesn't apply a globe rules, and below that, say it has two subsidiaries, A and B. And below B, let's assume you have B1 and B2 for simplicity perspective. So in case if A does not, the ultimate parent entity does not apply the globe rules, and there is a top-up tax required by B entity, then the right of the top-up tax of B entity will get passed on to its subsidiaries, that is B1 and B2. And that will then get allocated between the subsidiaries in based on their tangible assets as well as number of employees in the ratio of 50-50. Let us step a little backward and really evaluate why would countries not want to apply the globe rules. Because if one really says the globe rule is to ensure that everyone has a base minimum playing field, minimum of minimum tax rate of 15%. So from a taxpayer perspective, if the overall effective tax rate is lower, they have to shed that tax. If a given country does not pay, it is losing on its, by not bringing in global, it is losing on its share of those taxes, and it is empowering another government to do it. So that is what no government would really want to, so I really don't, I see that as a very limitation in terms of countries not choosing to apply global. And as a consequence of this, what will really happen is that it will, the decisions which today were largely driven based on taxes, for selecting a jurisdiction would sort of dwindle, and other business and commercial factors as well as indirect tax benefits will trigger it.
I completely agree with you that the tax benefit simply will not drive the businesses from one jurisdiction to another or opening an entity just for the sake of taking tax benefits. It'll be more driven from a commercial sense now. Tax
That's
sense
right.
is not the only thing to change. So, Sarika, now to you. Do you foresee a lot of uncertainties and instability in the times to come, considering that administrative and compliance struggle for tax authorities as well as taxpayers, given that we have less than 12 months to implement this detailed and I would say yet unwritten law, because there are many parts of this law which are yet to be announced and yet to come out, yet to have to come out in public for consultation as well. So, how do you foresee the future?
No, you're right. I think although OECD has clarified in the Model Globe rules that they are designed in a manner and with an objective of minimizing the cost and complexities for both the tax authorities and the taxpayers. Although they've mentioned about using the CBCR style threshold, and they're going to rely on entity level financial information, using certain consistent approach which we are already following, like deferred tax accounting to deal with the timing differences, etc. But they've also clarified that additional administrative guidance will follow with respect to detailed filing obligations or maybe multilateral review processes. So, since the parent entity would need to file the Globe information return and the format, etc., is still to come, it will be extremely challenging situation for the MNE's point of view. And also, saying that, assuming that these are enacted from January 23, and realistically seeing we just have 1 year to prepare ourselves for the upcoming compliance challenges. And also, besides the compliance challenges, business may need to basically relook at their readiness in terms of accounting aspects, their system related issues. At a micro level, these things really matter. That thought would need to be given whether the business has appropriate system, they have appropriate governance and a sort of a tax strategy to respond to these upcoming changes, or will they need to develop something? So it is a big preparation for multinational companies, I believe.
True, true. I think the preparations must have started at various M&E levels. That how do they look at it? What is the impact? An impact assessment must have started at various M&E levels. And Shilpa, I can think that there would be situations where both Pillar 1 and Pillar 2 would apply simultaneously to a company. And this will definitely lead to double taxation. What do you think? And in your research, did you come across any other situation where you think there would be double taxation?
Sure. So yes, if you look at Pillar 1, it provides the taxing rights based on market jurisdiction, where the turnover is more than $2 billion and profits are greater than 10%. Whereas Pillar 2 looks at MNEs which have a consolidated turnover more than $750 million. So obviously the multinational groups which get covered under Pillar 1 could also would be covered under Pillar 2 as well. So yes, both would be applied. With that, if one really looks at in the blueprint, which was there in October 2020, in the covered taxes, there was an exemption for digital services tax. Right now, we need to wait for the explanatory commentary, which is expected somewhere in the later part of January, in terms of how are they dealing with this particular aspect and what it is there. If there is no specific exemption which is there, then yes, definitely this could lead to a double taxation. Having said that, there will obviously be the OECD will have to even give various clarity if it gets covered under the exemption. For example, if under Pillar 1, if the entity is not in a given jurisdiction but still taxes get covered, then how would those be dealt with in Pillar 2 when you are doing the calculation of the effective tax rate? And even if there is a jurisdiction, should that tax rate be considered as part of that jurisdiction, or it should be considered as part of the jurisdiction which has made this payment? So that we should definitely look at clarity on that. And yes, yeah, you want to
please continue.
And yes, there would be several other scenarios which I could think of presently. And, as we read the fine prints more and more and the explanatory coming in, there could be some more scenarios for double taxation as well. The first and foremost is while the model rules expect every country to adopt as it is, in case if countries adopt the model rules differently, then that could lead to double taxation. The second would be in terms of the local country laws vis-a-vis the globe rules. So, for example, in India, if we are going to compute the profit before tax in a given thing, and globe rules basically look at making adjustments to your financial statements. So obviously, some things like accelerated depreciation, etc., which would be allowed, and there could be a lower tax in one side, could not really be available in the other scenario. So those such differences could result in. The third, which I could see, is in terms of the deferred tax assets. If one looks at the model rules, it clearly says if a deferred tax asset is beyond 4 years, you will not get the benefit for the 5th year onward. So let us take you have a deferred tax assets of 100. So it would get, you will get the benefit for the 4 years, but in the 5th year, the 20 which is there is not there. So to that extent, you will have to pay that, and that would lead to. Others would be if there are disputes arising as a result of any disallowances which happen during your assessment proceedings. And so, you may still have some income which could get taxed, and in your in jurisdiction, whereas the same would have been allowed as an exemption in the globe rules and result. And the fifth, which I could think of, is if, say, a globe return is filed and a given country says your ETR rate is 13%. But when it is being looked by the ultimate parent entity, and the ultimate parent entity says, no, this calculation is wrong. The effective tax rate should not have been 15%. It should have been 13%. And therefore, I have the right for 2%. So that also would result. Presently, the model rules are silent on how these double taxation or disputes would really be dealt with. I think all taxpayers and we as professionals, what we are looking at is in terms of some guidance in terms of how this dispute resolution will be addressed.
I think MAP could be the way out on this as well. Maybe the implementation rules will throw some more light on how the dispute will be resolved in these kind of scenarios.
Yeah, we need to see, because this will be enacted through the domestic law and not through the treaty. So we'll have to see how does MAP come in, and
That's
also the MLI in case if they choose a route similar to MLI for implementation.
Sarika, I have a question for you. With a minimum 15% tax payable by every multinational enterprise on its global revenue, along with extensive compliance burden for the ultimate parent entity, do you think M&E groups will have a relook at their holding structures? And are we practically at the end of an era of complex business models which are aimed at just achieving tax efficiencies? Are we at the end of that era?
Yeah, I think it appears to be a correct input. This might be the need of the future, because the rules talk about additionally on the compliance side, MNEs will have to pay the top-up tax calculated in low tax jurisdiction. So it will certainly bring extensive compliance obligations for the parent entity. Also, it will depend, as Shilpa also mentioned, that will depend upon the fact that in what shape and manner and in what form these rules, basically the IIR rule and the UTPR, will individually be enacted by each jurisdiction. And talking about India and the past compliances that we've seen introduced around CBCR and master file, it appears that the companies would need to be careful and extremely cautious of the compliance and related filing obligations. Also, talk about the holding structures, you may be right, because since global minimum tax is eventually going to bring down all the jurisdictions at par with respect to the tax rate, which will be like minimum 15%. So I feel the restructuring options for companies might reduce as there'll be a tax neutral environment wherever they are structured in future. So any company or any MNE who would be, say, operating from a low tax jurisdiction currently because of obvious reasons may not find it worthwhile, to do so. And thus companies may deliberate now on relooking at their legal and holding structures in terms of now more convenience and driven by more commercial and operations perspective rather than the tax reasons. So yes, it looks like we are going to be in an environment or in an era where probably holding structures based on tax rates in various jurisdictions might not be the future.
So we are at a age when we are going to see a paradigm shift in the international tax framework, which has remained same for centuries.
Yeah, and that was the intent of BEPS 2.0 and the intent of OECD and inclusive framework countries to basically stop this practice where this whole shifting of the things are happening.
So this whole international tax structures and things will become much more simplified and much more manageable even for the tax authorities world over, because now they will have limited things to look at and in a more simpler business like manner. So the companies will not have to now anymore prove that they have a business purpose of opening an entity in a particular jurisdiction, because that will be the only purpose of opening a jurisdiction entity in any jurisdiction now.
Correct. That appears to be the intent. However, having said this, whenever any law comes or any new change comes, and because it also has its own exclusion, like I was thinking that shipping companies are, excluded, and there are other parts or aspects which are excluded. Maybe big fours and consultants will think around some other strategies to to work around on those things.
Yeah,
it's an ongoing process.
More work for all of us.
All of us.
So now, Shilpa, thinking of you as the big daddy in the picture, it stayed out of the MLI, stating that they have base erosion and anti-abuse tax beat. And for Pillar 2, they have their guilty provisions, which is the global intangible low taxed income. So, and OECD has also very clearly stated that the guilty provisions will coexist, and this coexistence will be considered at the time of implementation framework, when the implementation framework will be issued. So, what if a situation where these changes, because this is a change now US has to make domestically. So, what if the changes brought by US in guilty provisions are not able to meet the qualified IIR norms provided by the model rules? What are your thoughts on this?
Sure. So let us understand two things about guilty provisions. Today, guilty provisions is looking at the minimum tax, to be taxed for all the US companies, which is on an aggregate basis, whereas Globe 2 is looking at on a jurisdiction basis. Right. So that is something which would have to be addressed through the explanatory commentary. The other is, if one looks at effectively for large companies, the guilty works out to be somewhere between 10 to 13.5%. And that is also a rate which needs to be increased to 15% for it to be qualified as an income in the income inclusion rules. So these two things need to be really addressed, and we should look forward to the explanatory commentary which will come in. Having said that, if while the intent is, and I'm sure OECD would work towards ensuring that the big daddy is really addressed. But if that is really doesn't take place, I think we are looking at a complicated mess. It's like US has already not signed the MLI, and it could also walk out of Pillar 1 and Pillar 2. So we need to wait and watch in terms of how this really shapes up and how what comes in through the explanatory commentary.
Practically, with most of the big multinational enterprises headquartered at US, we are looking at a point of it'll be the point of decision, because if US doesn't change the laws, the effectiveness of this whole global model rules may not percolate to all the companies. It will not give the real impact. The intent may get lost because of all this. So it's really important that US changes the law, the guilty provisions, to be in line with the globe model rules. It's really important for that.
So we need to see what Biden does on this.
Right. True. It's really in his hands now, how this whole international tax framework, which has been developed over last 4 or 5 years, 1 country is working on it together, OECD working day night, and it may not see the light if US doesn't change the law. And Sarika, with the GAR already in play and GMT being introduced, do you see there will be an interplay? How there will be any impact on the GAR provisions, how they are being invoked by the authorities? What do you think? What will be the interplay between GAR and GMT?
See, I think GAR is quite, wide in its applicability. It's basically, it covers in its ambit any agreement or any arrangement which lacks commercial substance, or it creates rights and obligations which are not ordinarily created between persons dealing at arm's length, or it's entered for, say, non-bona fide purposes, etc. Whereas GMT, the rules that they say, will basically address one main problem, that where multinational companies are resident in high tax jurisdictions or tax haven countries, are purposely, say, operating from a low tax jurisdiction to save on tax. But having said this, I feel GAR at its basic premise considers an arrangement to be an impermissible avoidance arrangement, the main purpose of which is to obtain a tax benefit. That's the starting point. And if I remember, the Shom committee also had changed this language. Earlier, it was that one of the main purposes, and then they make it as the main purpose of which is to obtain tax benefit. Now, after the GMT rules comes into picture, which would basically bring all the jurisdictions at one minimum standard rate of 15%, it's important to think, would there be actually any situation that the tax authorities will be able to contend that the main purpose of this arrangement was to derive tax benefit? Because prima facie, there is no tax, differential rates are there to make some arrangement like that. To my mind, I think after introduction of these rules, the possibility of the contentions by the department of any arrangement falling into GAR might reduce. If it will not totally go away, but it will probably dilute the provisions on the GAR.
I completely agree with you on this, Sarika. I think that the whole premise of invoking GAR is that you are achieving some tax benefits. The tax
Yeah.
benefit have been taken away. It's same
Correct.
tax rate for every jurisdiction. So I couldn't be motivated to move from one jurisdiction to another, or to make a particular arrangement just to achieve some tax benefits. What's your take, Shilpa, on this?
Yeah, I agree with you, because if one really was even to take a hypothetical example in terms of how it would work. So let us take, for example, there is an Indian entity which is doing procurement services, and it was earning a profit of, say, 100. And based on the tax rate, it was paying tax at 34. Now let's assume that this function gets moved to a low tax jurisdiction, like Dubai, which has zero corporate tax rate. And say India just ends up doing some ancillary support services and things, which as a consequence of it, the tax in India works out to be just there. So if one really looks at it, the difference between the two is 20. And vis-a-vis that, if, for example, if you Dubai continued to earn the same profit of 100, and if under the GMT, the effective tax rate is 15, the group has to pay 15. So in effect, by moving the functions from one jurisdiction to the other, and in case, assuming if all the boxes of car got ticked, the group is actually in a far disadvantageous scenario. And so, it makes more sense that, companies would sort of reduce the aggressive planning which they are doing, and, pay all their consequences before they really make any such decisions.
Absolutely, absolutely. So we are all on the same page on this particular issue, that the GAR's impact will dilute. GAR, which so far also has not been aggressively invoked by the authorities, but it may go down even further. So, Shilpa, the model treaty provision to give effect to the subject to tax rule is also expected in March 22. What is your view? Why India needs to be a part of this change, and how it will impact?
So just a little background on the subject to tax rules. Subject to tax rules will only be applicable when it deals with related party payments. Second thing is, it is going to be complementary to the globe rules. So if, as a consequence of the subject to tax rules, if some tax gets payable, then that would be considered while in the calculation of the globe. Third is, while in the globe rules, the right to tax is with the ultimate parent entity or the UTPR, the taxing rights is with the recipient jurisdiction. So India definitely has lots of transactions, and so every country which has such international transactions, it would be the first one who would benefit of it. Presently, the services covered or mentioned under subject to tax rules is only royalty and interest. And then there are mention is other defined payments. So one needs to see what would be these other defined payments. India would be definitely interested to see capital gains, dividend, fees for services, and if not the entire gamut of services, at least fees for technical services forming part of this. The second thing is presently there is no threshold on this. So, if there is no threshold, then it covers almost all the transactions which would be there for payments to related party, which will get covered under this. Now, what a subject to tax rules will do is it looks at a minimum tax rate of ETR of 9%, vis-a-vis that GMT is at 15%. So if, for example, if a given transaction, like in some countries, dividend distribution tax is at 5% on dividend income, and here it's 9%. So the difference between 9 and 5, which will be 4%, India will get the right to tax that. So definitely this is a space which India would be looking for and watching, and would want to see how it develops, and would want to see at least all these three areas of capital gains, dividend, and fees for services being a part of the other defined payments.
And as far as I understand, the subject to tax rules will come through in the form of a multilateral instrument where all the treaty partners agree to this change. So that is another interesting point. So we will have an MLI 2.0 being signed by all the jurisdictions to give effect to this subject to tax rule.
True.
So, Sarika, so we've seen that it's a big change. Countries are fast in adopting this. EU was the first one. Do you think that India, in the upcoming budget, we will see the necessary changes to enact the income inclusion rule or any other change for that matter in the budget 2022? Sarika, for you, we're not able to hear you.
Sorry, I was on mute. So I'm just saying that it's kind of a speculation or a what we feel kind of in a situation that I feel the intent of the inclusive framework countries to implement this tax GMT is a timeline driven, because they're saying that it has to be enacted by 2023. However, considering the rules introduced would still require several clarifications, including the clarifications on computational mechanism. I personally feel it is a bit difficult that the government would bring in necessary changes to enact IRR in this upcoming budget, because it's just I think 10 days to the budget right now that we are. Also, I feel it's important that, or maybe it would be appropriate that whenever any such change is brought, it should come after thorough thinking is being given to the fact in what shape and form it should be introduced. Else it's going to be extremely challenging for all the multinational companies to adopt the same. And especially, those changes should be brought in consultation and with review from all the stakeholders, relevant stakeholders should also be done.
Agreed. So we can maybe, after the government is done with the budget announcements, they may start thinking on a public consultation paper to be issued to give effect to the globe model rules. That can come maybe after the budget is what we can think of. What is your take on this, Shilpa?
Yeah, I would agree with Sarika in terms of the budget. It's and I think it's good for the government to really wait and watch, because we still have the explanatory commentary which is pending, and if you have a larger picture on what's happening, you would be in a better position to frame the rules. Second thing is we need to also take in, government will also want to take cognizance of unilateral measures which are being taken by some of the countries. Like, for example, Italy and Swiss have said that if, for example, the effective tax rate in their jurisdiction is below 15%, then they themselves will have to top it up, and the tax in their jurisdiction has to be made 15%. Similarly, if you see, UK has also, HMRC has also put something on those lines. And the EU has come up with they want to apply the model globe rules to all the domestic groups to ensure that there is parity in the level playing field which they have. And also, wanting the EU members to have the rights so that the tax remains within EU rather than going to the other jurisdictions. So one will have to really watch and see how this space really develops. And, definitely a consultation with the industry is very important, because, then the law would be more taking into consideration the various aspects before one does. Having said that, one key question which really remains is that in India, the way the tax profits are computed is very different than what is coming out of the model rules. And while one of the wish lists would be, from a taxpayer's perspective, looking at group tax return, one really does not know in terms of how the Indian government would really want to do that. And the other thing is, well, how much, if one looks at adopting the model rules in line with, and based on that, changing the tax system, it will look at a complete overhaul, which again does not seem to be a practical thing. So there will also be a lot of challenges which will come up to the taxpayers because obviously they will have their financial books maintained in India. They would have the CBCR requirements and they'll be looking at that. Then there will be the globe rules and assume even if Pillar 1 gets applied. So from a corporate perspective, yes, there's so much to really look at. So while my expectation would be to unify, one needs to really see how the governments would want to address. And I really think if corporates expecting all the challenges to be addressed, it would not be a practical thing.
True. Sarika, any parting thoughts from you?
I think in the past we have seen many changes such as equalization levy, etc., coming up, and the language reads in a way that created a lot of confusions for some companies. And I remember sitting with some people from the authority side and explaining our point of view that the language appears to be covering every situation where I'm even talking to or placing an order on the email, which of course is not the intent of EN. So, what I think, urge the authorities or request through this forum that any change that will now come up because of GMT rules, it should be very clearly laid out and should be enacted after, thinking through all the possible outcome that the law could have.
Absolutely.
So maybe, whenever anything comes up, it should be a little thought through process through consultations and thinking through all the possible outcome from the perspective of a taxpayer.
Yeah, we don't want the government to hurry and issue a document with the budget. We want them to issue a document which is much more comprehensive and much more clear in terms of its real impact that they want to have.
Exactly. Because once this thing comes and there are clarifications which the taxpayer will seek, and those clarification also sometimes require further clarification. So it's like an endless thing for sometimes for the taxpayers.
One comprehensive document would be better.
Correct.
So friends, clearly the model rules will increase the effective tax rate of the in-scope multinational groups and will also result in administrative burden and implementation challenges as we discussed. So if I had to sum up what the tax leaders now need to do, what is their to-do list after this announcement is they should, I think, conduct a high level impact assessment of their business models, of the impact of this global minimum tax, putting in place a system for data collation and collaboration between the tax and accounting team, because this work cannot be done singly with the tax team, nor the accounting team can do it, because there is deferred tax adjustments, there are adjusted covered tax calculations, the globe income has to be calculated. So as I said in the starting, there will be a third set of books to be prepared collectively by the tax and the accounting team of a multinational entity, and there will have to be more information flow moving between the tax and accounting team, so they have to work in collaboration, ensuring that the transactions between constituent entities located in different jurisdictions are at arm's length. That's another aspect that has been clearly stated by the in the globe model rules, that the transactions between constituent entities ideally would be at arm's length price, but if not, they should be relooked and ensured that they are at arm's length prices. The companies need to ensure that there is a robust tax control framework to ensure that the compliance is in place to apply the globe model rules, to kind of adopt that, because otherwise this can result in a very high tax cost as well as a reputational risk for the multinational enterprises. So it is really important that the companies start looking at it from a tax control perspective. And needless to say, there has to be a continuous monitoring of the country-wise development that is happening to adopt the globe model rules. So what India does, what Netherlands does, what other countries are doing, what US will do, how US will change the guilty rules. So there is a continuous monitoring process that will happen in the next year to come. So though there are some documents which are yet to be issued, like the commentary on the model rules, which will explain the complex language which has been currently used by the global model rules. The language is quite complex. The calculations are even more complex. And it would help if the government is able to issue a kind of illustrative commentary which will give illustrations on each of the components of this calculation, because though I try to show the whole calculation, but there are essential components of this whole calculation, and if explained through illustrations it will be really helpful. The update on US guilty coexistence through the implementation framework. Then there is a model tax treaty that we are expecting to comply with to bring in the subject to tax rules. And the global implementation framework containing the safe harbor rule, because that is yet to be brought into picture, that what will be the safe harbor rule. And the reporting template is yet to be issued. So there are so many documents which are yet to be issued, and all in all, it's going to be an action-packed year for all of us, looking at how the whole international corporate tax framework is going to be revamped completely. And as we said, that it's really the end of the tax efficient planning era for the companies. They will have to relook at their business structures to ensure that the smaller entities which have been created just for the sake of tax sense should make business sense first. Otherwise, it'll end up creating more compliance burden than the tax benefit that could have been achieved. So thank you so much, Shilpa and Sarika, for having this discussion. And Jyotsna, over to you. We can address if there are any questions that
Right,
are
ma'am.
there.
I can see two questions out there in the Q&A box. One is from Mr. Kanwal Ohri. So I'll just read out the question. I have filed Form 15CA/CB, but it has still to be taken into account. While talking to help desk of Income Tax Department, they say now it cannot be filled as done earlier. Only manual filling is enough. Please clarify.
So this is kind of unrelated to the topic we are discussing right now. So we can maybe take it offline. You can share the query over an email to me, Jyotsna, and we can address that to you.
Sure, ma'am. Shall I take up the next question?
Yes.
So the next question is by Mr. Keyur. It says, how bare minimum tax will be taken care in case of a globe JV companies 50-50 ratio, and how the mechanism will work?
Would you like to address this, Shilpa?
Sure. So I think, the earlier rules, in October 2020 did give some illustrations, and we should wait for the explanatory commentary to come in to really bring out through an explanation how a global JV with 50-50 would be done, because this will definitely not have a consolidated, line by line reporting. So one needs to really see how to bring out the details around this.
So Jyotsna, I'll read the rest of the questions which we want
Right,
to
ma'am.
address.
I can take up the question from Ravi if you want me to.
Yeah, please do that.
You want to read that question out?
Yeah, the question is whether you foresee any changes being made in the IT Act to deductions under Section 80 LA, due to which the ETR for such an entity is lower than 15%.
Yeah, so if ATLA is basically, it will cover the IFSC, which is a gift city, which is set up where they've got a concessional MAT rate of 9%. Plus, they will be having, deductions of 10 out of the 15 years. So yes, one needs to really see with this fact and background whether, if that entity is part of other entities within the group, then of course, from a jurisdiction perspective, the ETR rate could still be higher because overall, ETR rate for where you don't claim tax holiday units is tax holidays is 22%, or it could be 33, depends on what companies have opted for. Having said that, from a taxpayer's perspective, of course, the ET minimum tax rate is going to be 15%. And so the question would be whether India as a government would want to give up the profits, which are, the right to profits in its jurisdiction and to another jurisdiction. So it could be that when the globe rules come in, India could consider bringing in measures similar to Italy or Europe or Swiss, which we spoke about earlier during the discussion.
So there's another question from Anil on probable date for enforcement of global minimum tax. So Sarika, would you like to answer this?
I think what OECD has given as January 2023 is the date that they're looking at to enact these rules. But before that, I think individually jurisdictional level, every country will have to basically insert those rules to take care of IIR and UTPR. So that's what the timeline appears to all of us.
I also see it could be a scenario because this has to be implemented in the domestic tax law. So obviously, OECD will complete its work and have all the framework and give you the forks and the spoons and everything the way it did for CBCR. And then it will be up to each country when do they bring it into their regulations and when do this start getting implemented.
As it was probably done at the time of MLI, they had given those dates that what do you want to be the effective date of those covered agreements. Something like that can come up.
Yeah, enter into force date, enter into entry
force,
date.
yes.
Right. So those dates could be different for each of these jurisdictions as well, right? Also based on the year being followed, well, it's calendar year or the tax year. So that will also have an impact on the enforcement date of this change if brought by India and even globally. So Shilpa, you want to address any other question or should we call it a...
I think Shubham's is just a comment, so there's nothing. We have another comment.
Right. Yeah, so there is a question from Malika that would the countries that will not want to be compliant of globe rules be at any disadvantage? Yes, clearly they will be at a disadvantage because if they are present in a particular jurisdiction, if a company is present in a jurisdiction which has low tax, the tax that is not being paid by that entity in that jurisdiction will anyways be paid to the parent entity. So in the tax jurisdiction where the parent entity is resident. So the tax is paid by the company, just that the low tax jurisdiction is not getting the tax. So the companies are not coming to those jurisdictions anymore for a tax benefit. So might as well top up their tax, might as well impose a domestic top up tax or increase their domestic tax rate. That's another change, Shilpa and Sarika. I think that many countries will start increasing their domestic tax rate to a mere minimum of 15%. That's another big change that I can foresee as happening because they don't want to be in a competition anymore because this competition is not giving them anything. No foreign investment is coming in just for the sake of the lower tax rate. So many jurisdictions which were offering those sweetheart deals will stop offering that, I think.
Right.
As Rahul said that since globe rules are optional, will it not lead to defeating the purpose of such rules? I kind of disagree with you, Rahul, here because the purpose will still be achieved, whether through IIR or through UTPR. The tax will be paid. The top-up tax that has been once calculated to meet the minimum effective tax rate will be paid by that company, whether a country opts for it or it doesn't opt for it. The companies who are paying the tax will have to bear the tax cost.
There's another comment from Vipul Kothari, which is talking about, the for credits being allowed by other jurisdiction for the top-up tax. So that was something which was there in the blueprint, and we need to see what the explanatory commentary brings in. But logically, I think, yes, there should be this credit mechanism which should be available. So if your ETR in a given jurisdiction is more as compared to another, the set off against that credit for that, as well as, carry forward of ETR. So we need to see how the explanatory commentary comes over this to really address this aspect.
There's another question from Yatin Viswadia. Do you see that GMT will help removing the place of effective management rules?
I think, I think it might happen, because what we are trying to do by inserting POEM is that if a company is resident in some other country, but because its place of effective management is in India, we want that country or that company to get taxed in India. Now, with the GMT coming into picture, we don't need these reliance or these kind of provisions. So there would be something, I think, which would change on the POEM aspect, as we are expecting the EL also to go away, and maybe some digitalized provisions that many countries had introduced might also go away. So I feel there could be some changes on this aspect as well.
What is your take on this, Shilpa? Do you think POEM will go away?
I've really not given a thought to comment on it, so I don't do a quick shot on it.
Fair enough. I think that brings us to this end of a very healthy discussion on how GMT has been brought in, what impact it is going to have, and what are the implementation challenges that we are facing. And a lot of work for all of us to do, a lot of reading, a lot of research, and wait and watch on how things change globally and how countries adopt these rules, what OECD has in store through the implementation framework. So thanks for the discussion, Sarika and Shilpa. Over to you, Jyotsna.
Thank you so much, Neha.
Thank you.
Thank you, Ms. Neha, for moderating the session, and thanks to the eminent panelists, Ms. Shilpa and Ms. Sarika, for sharing their valuable inputs. Now moving on to our session 2, which is a panel discussion on the key developments and issues in taxations on foreign remittances. The session will be moderated by Ms. Richa Sahni, who is a chartered accountant, and the eminent panelists are Ms. Rashmi Maskara, who is partner Deloitte India, Ms. Dinal Dedia, head of tax at Central, and Ms. Rekha Joshi, Broadcom. So handing over the stage to Ms. Richa. Thank you.
Thank you, Jyotsna. So after this interesting discussion on global minimum tax, we come down to something which is more regularly being dealt by all of us who are looking at the taxation part of things. So let me start this session with a short presentation just to set the context and also give a flavor of things to come. Now, for a person making a foreign remittance, a lot of groundwork is actually required before the actual remittance is made. To begin with, there is the correct characterization which is required to be done, and this is done under the provisions of the Income Tax Act. If you could move to the next slide, please. After this characterization is done, that is once you've determined whether it's a case of royalty, FTS, interest, or business income, next comes in the stage of scrolling through the Act to see if there is any special or a general provision which needs to be applied to determine the correct withholding tax rate. Post this, one needs to see whether any treaty benefit is available. At this stage, it is relevant to examine the availability and the content in the tax residency certificate. One also has to look at the various conditions which are specific to a particular article or the overall anti-abuse provisions under the tax treaty, and also has to take into account if there is any lower withholding certificate which is there. Post this stage, the next thing that becomes important is actual deduction of taxes and deposit with the government, and then making the remittance. At this stage, it is Form 15 CA-CB compliance, which assumes importance. After this, the final step is filing the withholding tax return. And with this, there is a conclusion of this process. Now, historically, taxpayers have faced challenges at each and every step of this entire process. And these challenges are both on the interpretational side and also on the procedural side, many of which they continue to face. But in addition, there are several significant legislative and judicial developments which have happened in the past 2 years, which they now need to take note of. And this is what we will be focusing on in this session. So we've picked up some of these key developments, and let me walk you through the key ones. Now, in March 2021, the Apex Court resolved a long-drawn debate, in fact, a 2-decade-old debate on the tax characterization of software payments. The issue of copyright versus copyrighted article. A lot of us started our careers dealing with this issue. What the court held was that payment for sale, distribution of shrink-wrap software does not constitute royalty under the tax treaties, which are based on the OECD Model Convention. So that's important to take note of, the OECD Model Conventions. Another important aspect of this decision was the reliance that they placed on the Indian Copyright Act provisions. The court held that there cannot be any copyright in existence in India outside the purview of the Indian Copyright Act. And it is extremely important to see the terms of the license agreement in light of the provisions of the Copyright Act. Now, an update on this. The Revenue has filed a review petition as regards this ruling. Moving on to our next key development. Another thing which became really important for taxpayers or remitters to consider is the interplay with the equalization levy provisions. Currently, there are two rates of digital tax in India, that is the 6% EL on the digital advertising. Here, the deductions have to be done by the Indian payer. All the compliances have to be carried out by the Indian payer. Then by Finance Act 2020, the 2% EL on e-commerce operators came into being. Here the compliances are with the non-resident recipient. So here different stakeholders are involved where compliances have to be carried out by two different set of people, and therefore that starts the tug of war. Now, why is it important to evaluate while making remittances? Because of Section 10, subsection 50, which stipulates that in the event any payment, there is a levy of equalization levy rate, then it is exempt under the provisions of the law. So therefore, the whole process of withholding tax and evaluation of digital taxes has become interlinked. When these provisions of 2% levy came into being, there was a lot of confusion for a year as to whether what should one see first, whether needs to look at royalty and FTS or provisions first or the EL provisions. So this was clarified by a retrospective amendment by Finance Act 2021, which said that you need to look at the royalty and FTS provisions first. And therefore, if in any case, the provisions of royalty FTS or royalty FTS tax is payable under the provisions of the Act read with the tax treaty, then you need not apply the EL provisions. Moving on, another important development has been that from financial year 2021, provisions relating to SEP got activated. These provisions are an integral part of the business connection provisions under the domestic law. Government also announced the user and the revenue thresholds, which a lot of stakeholders feel are on the lower side. Now, why is this important? This becomes important in case of payments which are made to residents of non-treaty countries. As you're all aware, as far as the treaty countries are concerned, the concept of PE is much narrower, and therefore it kind of supersedes the SEP provisions. But even in situations where a treaty is applicable, but for any particular reason, and the reasons could be multifarious, you could end up having a situation where the treaty benefit is not applicable. So these provisions would have an impact while making remittances in those cases as well. Also, in many cases, there can be an overlap of the equalization levy and the SEP provisions. So therefore, a careful analysis by anyone making any remittance is now required. Yet another interesting development has been that Finance Act 2021 defined the term liable to tax. The focal points of this definition are that there has to be an income tax liability under an existing law for the time being enforced. Please take note of this line, an existing law. Or there is a current liability, but there has been a subsequent exemption. So all those earlier rulings which talked about a potential liability in future were overruled. Now, given that this term is not defined in most of the tax treaties, a recourse to this domestic law definition is required in many cases. And in cases of transparent entities and payments to residents of countries where there is no tax or personal tax regimes, this evaluation assumes a lot of importance. Yet another interesting development was that MLI provisions became effective from 1st April 2020. So far, the government has released around 27 synthesized text of tax treaties for the covered tax agreements. And now it becomes really important that a careful analysis of treaties considering the MLI provisions is carried out to assess whether treaty benefit in a particular case is available and the correct withholding tax rate. One of the key provisions here is the PPT provision, or the principal purpose test provision, under which the treaty benefit can be denied if obtaining such benefit was one of the principal purposes of the arrangement. Given that this PPT is a relatively new provision, a new anti-abuse provision, the scope and impact is untested. So this is something that any person making a remittance has to factor in. Yet another landmark development has been that India reverted back to the classical system of dividend taxation when the DDT regime was abolished by Finance Act 2020 and dividend became taxable in the hands of the shareholders. So maybe after several decades, we started looking at the withholding tax rates to be applied when making payment for dividend. Most of the Indian tax treaties have a rate of 10%, but there are some where 5 or 15% rate is also there. This also brought into light the evaluation of the term beneficial ownership and the MFN clause, which assumes a lot of importance here. When these changes had happened at the very early stage itself and giving a very good direction came in the decision of concentrics, which was by the Delhi High Court, and that in context of the India-Netherlands Treaty, where the tax rate is 10% held, that a rate of 5%, which comes in through the MFN clause by looking at the Slovenia, Lithuania, and Colombia treaty, can be imported into this particular treaty. There are some interesting analysis about this development, which we will take up in our discussion. Yet another interesting development here was the Telcom ruling, though it was in context of section 194E, which is payment to sportsperson. It had a lot of a wider ramification. What the court said here was that no recourse to tax treaty can be taken at the stage of tax withholding. Now, it's important to note that the sections that they were referring to here were the sections where the withholding tax rate is already given in the tax treaty, and there is no reference to the rate of tax. Most impacted was dividend payout to FIIs. There was a lot of representation made by the FIIs for this. And then Finance Act 2021 extended the benefit of lower tax treaty rates to the FIIs at the withholding tax stage itself, when they said that you could simply rely on the TRC and give the benefit. This change was done in section 196D, but there was an open issue left as to whether one still needs to look at the beneficial ownership aspect. One interesting development that happened was the overlap of the TDS and the TCS provisions, which we have witnessed over the last 1 year. In this case, the scope of TCS was expanded to the foreign remittances, that is the LRS scheme. TCS of 5% on remittance under the liberalized scheme became applicable. This impacted remittances being made for maintenance of students, for medical treatment, and several other important things which are regularly taken benefit of by many taxpayers. What in practical side it meant was an increase in turnaround time for making these remittances. So with this now, let me now move to our other panelists to seek their insights on how these developments have had an impact on the taxpayers. Let's now begin with the software developments. So my question is to you, Rekha, first. That do you feel after this apex court decision on software, there is enough clarity as regards the classification when you're making payment for software? Are there any still you feel that still there are certain challenges which taxpayers grapple with?
Post the decision of the Supreme Court for the software payments, I feel that still these challenges continue. And what is happening is because of the fine lines that are there in the kind of software procurements that happen, we actually need to go at a granular level to find out what exactly is the nature of the procurement done, and even go and seek the advice of tax experts whether or not to withhold taxes, and then see what exactly could be the stance to be taken, because there's a very thin line of difference as to how to take it forward. And the apprehension what we have in our mind is more about whether if today we are taking a stance of a no withholding tax, what would happen whether over the years when assessment proceedings are picked up by the tax authorities, whether the companies would be liable to pay taxes because of a difference in interpretation that could come in there. So that is the apprehension and the risk which companies could have when they make these payments, relying on the decision of the apex court judgment here. So that is one thing which I feel it could still come in there. So that is one part of it. The next concern what I feel is there is considerable documentation requirement that needs to be maintained by companies. And the documentation requirement is quite complicated, whether it is the TRC or the 10F or whatever is required, confirmation of the right to use of the assets. All these things have to be taken care very carefully. And the documentation has to be archived over the years. Not sure when we can get those tax notices from the tax office. We need to be very clear about what it is. And there's also a need for a requirement of a very clear understanding of the tax treaties to be ensure that the correct withholding tax is applied when we take care of it. So taking into account the past experience what we have, and it would be good if there is some clarity. And what I feel is, I think there is a petition filed by Revenue and on this judgment from the apex court. And the historical thing what we see is usually whenever there's an apex court ruling that comes in, there could be always a probability where there's an amendment in the Finance Act and we would have a clear-cut guideline to apply taxes. So there's an apprehension it would come in. So, and it could be with retrospective effect. So that could put us, the companies in wherever we have taken a stance not to do withholding taxes. So those are the things I feel could be the challenges.
Yeah, let's keep our fingers crossed on this amendment that could do away with all the happiness that we've been, kind of enjoying, thinking at least some sort of clarity has stepped in. And also, I think, considering that this was in context of a non-OECD, the payments to non-OECD, again, a lot of reading to see kind of correlate the provisions with those which were relied upon by the apex court becomes really important. So to that extent, yes, there is a lot of groundwork required. But also, let me come to you, Rekha, with another question, a related question. This decision was primarily in context of software which is put on a medium. say it was on a floppy. Over the years, things in the software business, software world have changed. Today, we have downloading of software. We have things like SaaS. So do you feel that the principles that have been laid down in this decision can be easily extrapolated to cover these new developments or these new gen softwares that are there? What is your view on that?
See, at that point of time, it is important to look at the terms of the license agreement and what exactly is there to understand and evaluate whether this can be applied or not. That's very important here. And further on, we also need to look at the Copyright Act and then take into cognizance whether we need to apply this apex court judgment before we take it forward there. That's my thought around it.
Yeah, so what you rightly mentioned, that evaluation of the terms of the license in light of the Copyright Act, that becomes really important. Though it may be possible and to extrapolate it to, to a downloaded software or also to SaaS. So here I request Rashmi to you to step in and share your thoughts on this. To what extent this decision can be used in respect of the other kinds of software?
Thanks, Richa. So I totally agree with Rekha's points that yes, we will continue to do, we'll have to do the analysis, whether we fit into the parameters, which the Supreme Court has led. But having said that, the Supreme Court ruling is very clear, right? So they have laid down, how do we differentiate between a copyright and a copyrighted article? Just to discuss a few. The Supreme Court very clearly has mentioned that copyright is an exclusive right which is negative in nature, which means it restricts people from doing certain acts, which being the right to restrict others from doing certain acts. And also they have made a point that copyright is an intangible right which is quite independent of any material substance. Right. So I'll again, take the example of a book or a CD or a DVD, which we have been talking about for years now. So purchaser of a book or a CD or a DVD becomes the owner of the physical article, but that does not make the purchaser the owner of the copyright inherent in the work. Right. That copyright remains exclusively with the owner of the copyright. Right. So these are the things which the Supreme Court has laid down. And also one interesting point which the Supreme Court mentioned in the order, that the transfer of ownership of the physical substance in which the copyright subsists gives the purchaser the right to do whatever he pleases, but he does not get the right to reproduce the same and issue it to the public. Right. So that right is exclusively with the owner of the copyright. And this is how we will have to, continue to distinguish between a copyright and a copyrighted article. And also one interesting point, the Supreme Court in the ruling has also rejected the argument of the revenue, where the revenue said that some of these agreements, the end user license agreements, mentioned as EULAs in the order, term the transaction not as a sale, but as one of licensing, right, in the agreement. The Supreme Court has gone ahead and said that, it is a settled law that in all such cases, one has to look at the real nature of the transaction by reading the agreement as a whole and all other accompanying documents in the subject case, and not just the EULA on a standalone basis. So while the Supreme Court has given a clear-cut guidance on, these are the things one has to do to distinguish between a copyright and a copyrighted article, but I would agree to Rekha's point that yes, still a lot of boxes to be ticked, where, before we conclude that yes, this is not royalty and hence does not require withholding tax.
Yeah. So in nutshell, a lot of issues got resolved,
Yes.
but yet there are certain areas where the taxpayers still feel skeptical. But I think one is significant point to note from this decision is that they also said that you could take recourse to the OECD commentary. And a lot of these things are very explicitly coming out in the OECD commentary. So that does give some bit of comfort. But yes, again, as you mentioned, the thin line is to examine the terms, see the actual substance of what you are getting vis-a-vis just talking about the nomenclature. So, the substance of what you get becomes really important. Okay, thank you. With this, let me move on to the other significant development in this arena, and that's about equalization levy. And my question is to you, Deenal. So in equalization levy, we saw these changes happening in Finance Act 2021, that is about royalty and FTS. You look at them first. And if you're not paying any taxes, say the thumb rule is that either you pay 10% taxes under the law. If you are taking any benefits, say if make available or any other thing is there and you do not end up paying any taxes, in that case, EL become applicable. So do you feel that this clarification and overall clarifications issued in regard of the equalization levy have actually cleared the issues that were being faced by taxpayers?
Sure, Richa, thanks. So let me kind of give an industry perspective to this, or a lot of confusion that the industry is going through this. Now, before we even go to royalty or FTS, the first and foremost, the principle that the equalization works on is that whether you are actually an e-commerce operator, whether you are owning, operating, or maintaining any e-commerce platform, right? And that's where in effect, this is applicable to the non-resident taxpayers. So now, the first thing that the industry, generally comes up with is: are we really an e-commerce operator? What is it that gets covered? Does sending emails get covered? Does holding conferences on Teams or WebEx get covered? Does making payments or receipts get covered? And if the answer to that is yes, then why not mention that it is applicable to each and every taxpayer which is into an international business? What kind of a business can happen without all these things being done digitally? So that's the first and foremost question, and a big time clarity is required, that look, this equalization levy is only applicable to the biggies in the e-commerce operators like Flipkart, Amazon, etc., and not to each and every industry. So that's the first kind of confusion. And with this global minimum tax coming in, with the news coming in that equalization levy may eventually go off, a lot of industries are still into wait and watch mode. Having said that, this has become effective from 1st April 2020. The organizations which have yet not filed returns, the due dates being pushed, this analysis is still for industries is still at the final leg. Now, what is in it to analyze? A lot of past positions, Richa, that need to be evaluated. If in past you have been saying that it's a royalty and FTS, and you have been withholding taxes, then fine. But what if you're saying no, it's not royalty FTS, it's a business income, and you do not have a PE in India, and therefore withholding tax doesn't apply? But now, if that is the position, then suddenly equalization levy starts becoming applicable, and then the foreign entities are required to obtain tax registrations in India. There is a compliance burden which no MNCs want, specifically in country like India. And that's where another thought that comes up, that is it better to pay with royalty, FTS, withholding tax, and live with this 10% tax and buy peace with the Indian tax authorities, or and therefore make that decision, because at least that royalty, FTS, withholding tax is creditable on the other country taking the treaty benefits or whatever. But equalization levy again becomes a tax cost to us. So that's again one of the position to be taken, keeping into consideration what positions we have taken in past, because if you do anything, again your past becomes questionable if it's a conflicting decision made. So yeah, these are the thoughts, Richa, which we are struggling with in terms of
Very true,
equalization levy.
In fact, for a lot of remittances to group companies, this evaluation becomes really important, because the compliance burden in case of royalty and EL is on different entities. And yes, there is indeed a lot of clarity required on the EL provisions, group reimbursements covered, or, just a platform, a software platform which is being used, who becomes an e-commerce operator. I guess it would be really helpful if some more guidance can come in this
Yeah,
direction.
and one more thought to it, Richa, is that uh, let's say uh, let's say the foreign entity does this equalization levy applicability, and for that entity there is a section 1050 exemption available. But does the later on the tax authority come into picture and catches hold of the Indian remedy and says no, it's a royalty FTS, and that's why I do a 40A IA disallowance. So it's like entire expenditure being disallowed, and that's a question at stake. So that's also one of the important angle to look at when
So
we
these
evaluate.
have really actually become really interlinked.
It is, yes, absolutely.
So I'll request Rekha, you to pitch in here, and we just talked about software. So do you think these interlinkages between software payments and EL have a bearing, which is causing some bit of confusion for taxpayers?
Sure. I kind of agree with Deenal here that companies are facing this additional levy of equalization. And especially even though we have the clarification that consideration received for sale of software is not taxable as royalty under the Income Tax Act and along with the treaty provisions. And this is going to increase the compliance cost which companies are facing, especially the MNCs in India. And with a whole lot of procedure that could come in, the complicated procedure of doing whether to do withholding taxes on royalty or even do the equalization levy. There's clarity required on how to get these provisions worked out for the levy to be computed. So what I feel is it could be like a kind of a detailed FAQ on the technical ambiguities, what we are facing should come out. Otherwise, the companies, especially the MNCs, are very apprehensive about these additional costs, which keeps coming in uh, to the companies here. So that's the thought which I would want to share here.
Yeah, thanks, Rekha. So, and I think a lot of groundwork required. The extent of groundwork, the hours
Yes.
spent in before making a remittance has actually gone up sizably.
Yes, yes.
So, with this, let's move on to the SCP. What are the challenges that are, being faced with the SCP provisions coming into being? That has also become an integral part of the assessment exercise before any remittance. So I'll request Deenal for you to come in and give the industry perspective on this.
Sure, Richa. So before I give the perspective, significant economic presence is something that comes into picture for each and every transaction, so to say, whether it is a sale of goods or sale of services, or whether it is received in India, outside India, whether the contracts are entered in India, outside India. So the ambit is actually wide, and what eventually the aim the government uh, looks like is trying to achieve is that anything and everything which is not under royalty FTS, which is not been taxed in India, gets covered, right? So that is something, and with this, at least with the treaty countries, we are still able to apply the treaty rates. But the problem is again the compliance burden, because as I said, MNCs do not want to be tax registered in India and then get into that recurring compliance burden. So that is something which is an area to be looked at. Now, a thought then comes in is there any, because 911 as such, which is covering this SEP provision, is more of a generic provision. Can we really look at a specific provision to the transaction that we are evaluating, and therefore we say that we still fall into that section, and therefore 911 or SEP doesn't apply. So that is something that we could look at. When it comes to looking at it from the remedy perspective, if we know somebody could still have significant economic presence, what is it that as a remedy, what declarations we need to take? Do we simply withhold at 40%,
or do we still take a shot of Section 197 certificate, obtaining that? But then what if the government authorities, simply say that no, lower withholding is not applicable? So that is again a concern area for an industry to go in for 197 as well. So yes, even this SEP is something that we are still evaluating, wait and watch mode, and concrete decisions are yet to be taken, honestly. Yeah.
Very true, Renal. So, these are very widely worded, very expansive provision, which can take into account even physical imports. And the rate could be as high as 40%. And as you rightly mentioned, analysis required on whether, the specific provisions supersede this provision, or you simply just go by a 40%. To what extent should one rely on the declarations, considering that the thresholds are very low? So, you may not feel comfortable enough with the declarations also. So yes, I believe a lot of guidance would be useful in this direction. So with this one, let's move to our another development that we've had in the last couple of years, is the definition of liable to tax coming into being. So here, I'll request Rashmi you to step in, and how does the evaluation to individuals in countries where there is no income tax been impacted due to this particular change in law?
Sure. So I will, first talk about, the change in law, and then, go to, what the impact could be. So in case of Indian citizens whose India source income exceeds 15 lakhs, there is a deemed residency provision which has been brought in, which triggers when such person is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria. Now, we can clearly make this out that these words are borrowed from the tax treaties. The phrase liable to tax has been defined to mean that there is an income tax liability on such person under the law of that country, his home country, for the time being in force, and shall also include a person who has subsequently been exempted from such liability under the law of that country. Now, we all know that there are countries which do not impose any income tax liability on individuals, and these countries are like, say, UAE, BVI, etc. So effectively, it would mean that all these persons who are not liable to tax in those countries like a UAE or a BVI or any other foreign country for that matter, would be regarded as residents but not only resident in India. Right, so this, this created a lot of hue and cry, and CBDT later on, in its circular had clarified that bona fide workers are not targeted, right? So this actually, further adds to the anomaly as, what do we mean by bona fide workers? So does it mean that non-bona fide workers, would automatically come under the radar? We'll have to wait and watch that how this would be done. Now, one simple approach could be to simplify, to simply deny the tax residency of UAE. Say, if we're talking about an individual coming, from UAE. However, tax treaty needs to be interpreted in a, in a generous manner. And, if we were to apply the tiebreaker, most likely it might happen that, the person would tie break into UAE, and therefore, the India-UAE tax treaty would still apply. Now, we'll have to still wait and watch that, in such circumstances, could the tax authorities resort to the general anti-avoidance provisions, since that, overrides the tax treaties. Okay. Now, having said all this, it is worthwhile, to note that this deemed residency provision does not make that person a resident and ordinarily resident in India. Rather, that person will be an RNOR. And therefore, the scope of total income is restricted, and global income is not, in any case, taxable in India. Some of the impact which I could think of maybe is the section 115A benefit for interest, dividend, royalty, FTS, would not be available, or an applicability of 5627B, there could be additional, compliance burdens like mandatory filing of return and, stuff like that.
Yeah. So yeah, I think rightly pointed out by you, Rashmi, that yes, the impact got diluted to some extent because they did not end up being the ordinary residents.
Yeah.
But yes, a lot of work required because in many cases, as you rightly mentioned, you end up reaching the tiebreaker rule.
Right.
So then a detailed assessment required to see. So though, on the face of it, one could say that just because now the treaty is talking about only a period of stay, but that is still not good enough, and a whole lot of analysis still goes inside in making that remittance. Yeah, thank you for this, Rashmi. Let me move to you, Deenal, now. Rashmi talked about the payments to countries where there is no tax regime. What are the challenges that you have encountered while making payment to entities which are transparent entities? They have been forever problematic, but now, have things improved, or, has the issue been aggravated?
I mean, it looks like there is no clarity yet also because again, tax transparent entities are originally something that those were taxable, but effectively they have been now exempted. So there is no clarity as to, as a remedy, what all certification or what all declarations do I take? Do I ask for the exemption certificates from them? How is it that I go about while making a remittance and closing the withholding tax percentile around it? So there is, I would say, there is still not much of a clarity, Richa.
True. And I would say, seeking, asking them to let us know whether they are a taxable unit per se, or there is a subsequent exemption which has been given. All these, require a lot of back and forth, eventually, a lot of time and effort.
And as a remedy, I mean, as the party to the other side, they may not want to share so much of an information as well. So that's
And in
also,
fact,
I mean, it's privy to them. Why would they give me so much of declaration?
True.
At first
So
place?
that is something you can ask from a related party, but may not be forthcoming from a non-related. And in fact, this gets
Absolutely, yeah.
the issue becomes more problematic in certain cases where after this definition coming in, you may want to consider this to be an entity. Say, for example, in S corp, you may want to say that this is something which has an exemption notification, so we should be giving a benefit here. But then you realize there are several other countries in the world who are not doing so. So there's always a dilemma that whether this is something that one should really follow. So yes, I believe this is one area which requires some bit of attention while making remittances. Moving on to the MLI, Rashmi. MLI and its provisions have become really important now. So what are the key things, the key aspects, or the key issues that you have really encountered while advising your clients how to deal with these provisions? Any problematic areas that you foresee?
Yeah, sure, Richa. So just a quick update before we, go into, what are the major considerations. So as we speak, total of 96 countries have signed MLI as on, as of December 21. Some are yet to submit their instrument of ratification. The MLI has already started to impact the bilateral TTs of, approx 68 jurisdictions that have ratified it. For India particularly, the entry into force is from 1st October 2019. Around 47 jurisdictions are covered with respect to India's tax treaties for the MLI impact. And India, and Richa, you had mentioned this in your opening slides, that India has released 27 synthesized texts of the tax treaties till date. Now, what are the major things one has to look out for? I would want to start with the principal purpose test, the popularly known as the PPT clause. We'll take an example. Say the India-Singapore tax treaty. Now, under the India-Singapore tax treaty, the rate of tax on dividend is 10%. Okay, and there is a condition that if the beneficial owner is a Singapore company which owns at least 25% of the shares of the Indian company, and if it doesn't hold 25%, then it is a 15% rate will apply. Now, PPT test applies to India-Singapore tax treaty as modified by the MLI. Accordingly, this benefit of 10% may not be granted if it is concluded, having regard to all the facts and circumstances, that obtaining this benefit of the lower tax rate was one of the principal purposes. Okay, unless we are able to establish that granting that benefit would be in accordance with the object and purpose of the relevant provisions of the treaty. Now, as we all understand, this entire concept of principal purpose test is very subjective. It is very subjective, and hence, one has to go into the commercial and economic substance of the Singapore shareholder. That has to be tested for it to avail the tax treaty benefit in India. So this is one thing. The other thing, to address treaty abuse, is one of the minimum standards, and it is established that entities have to meet the PPT and the LOB clause. I'll come to the LOB clause in a while. In my view, the other thing which also takes importance is the interplay of GAR with PPT. Now, PPT is much wider in its application because it says that one of the principal purposes should not be to obtain tax benefit. However, GAR says, main purpose should not be to obtain tax benefit. So we'll have to see, sorry, this overlap. Few other provisions around the permanent establishment status, such as provisions addressing artificial avoidance of P through commissioner arrangements or through splitting up of contracts. So this widens the scope of P, and one has to analyze all this in detail. Richa.
Thanks, Rashmi. So yes, things have become complicated, though the intentions are good, but these are untested territories, so one has to tread with caution here. Let's now talk about dividend. Dividend has become taxable now. So how has this impacted the entire process of making a remittance of dividends? Deenal, your thoughts on this?
Sure, Richa. So, Richa, while there is some bit of clarity that you could still apply treaty rates, etc., when you are remitting funds to the overseas owners, but then there are concepts like beneficial ownership that need to be evaluated, and there is no clear guidance as to what does this beneficial ownership mean. And you also need to see whether there is a substance in those entities when you are making a remittance. So a whole gamut of the judicial precedents that come into picture, which we need to evaluate or rely on. So clear guidance, if it comes through, as to how to deal with these two aspects, the substance in the remittees and the beneficial ownership of the the owners to whom you are distributing dividend. That would really clarify a lot of things. Another thing again comes in is when the remittee is either let's say a transparent entity to whom you are not able to apply the treaty beneficial rate, or let's say you feel that the remittee is not the beneficial owner, then can you really go one step up and look at the the parent of that entity, and then decide, okay, if that parent entity is also in the same country, could I still go ahead and give treaty rate? So that is something that becomes a bit of a concern area or the area to look at, because if we really eventually come back with an answer that no, we are not able to apply the treaty rates, and then if we look at the India tax provisions, then the tax withholding tax to the foreign remittees is like 15% plus surcharge and cess, which goes up to 21.84%. Mathematically, if you look at it, it is like reserves created out of the originally 35%, which is like 34.944% tax already paid, and on the top of it, that tax paid reserves, again you are paying 21.84% more, and that's what discourages the MNCs to come into India and invest in India, and that's why at least clarity on these aspects, or at least lowering the rates to, let's say, 10% or at least 15% without surcharge and cess, so that we at least come into parity with some treaty rates, and we can simplify the process. So that would be helpful. Now, when it comes to making remittance, it's like no fee declaration, this, that. There are a lot of other hurdles also for, and when you distribute dividend, it's like you have what if you have multiple remittees, so those compliances hurdles, the principal purpose test, everything that comes into play, which not just disturbs or delays the decision making process, but also the execution. So in terms of distribution of dividends, so that's what I think industry must be struggling through as of now.
So yeah, Deenal, you rightly pointed about the compliances, and I think that would get magnified to a great extent in case of listed companies where a lot of foreign shareholders are there. So I'll request Rashmi to step in here and share her thoughts on how they are dealing with it and to what extent one can rely on declarations.
Yeah, sure, Richa. So the basic documents that are sought in case of non-resident shareholders for payment of dividends are, say, a no P declaration form 10F and a tax residency certificate. Now, further, sometimes a declaration to the effect that shareholder is a beneficial owner is also asked for. While, of course, these declarations do not provide any, I would say, a blanket protection either to the Indian entity which is paying the dividend, or to the shareholder. But these documents definitely, can help a certain position to be adopted for withholding, and this can support the position. Now, depending on the quantum of dividend involved, what the Indian entity can do is, in addition into collecting these documents, is to obtain additional documents that substantiate the claim of the beneficial tax rate under the relevant DTA. The important ones being, which comes to my mind is, a document to support the beneficial ownership of the dividend, which is a condition for, without which we cannot apply the lower rate in most of the tax treaties. And thereafter, document to support, that the foreign shareholder is in compliance with the LOB clause, if it is there in that treaty, and or the PPT clause, if any, for applying the relevant tax treaty. Now, I totally get it. This is definitely a tedious task, no doubt, when it comes to large number of shareholders. However, there are consequences on the Indian entity. Hence, I don't think we have a choice but to ensure compliance.
True.
Yeah.
So talking about procedures and the compliances and the declarations, let's move on and to the historical and the current issues that we are facing in terms of the compliances on the procedure part of it. So I'll request all of you to step in here and talk about the challenges that you face in terms of 15 CACB, the tax residency certificates, or maybe the lower withholding certificates. So I'll request Rekha, you to step in and talk about the procedural challenges being faced, covering the domain that I just mentioned.
Yeah. Sure, Richa. So if you look at foreign vendor payments, it necessitates a complicated documentation requirement which needs to be made. And while on one hand, we try to get the documents from the vendors who have made those supplies to us, whereas we have this TRCs, the 10F, and the other things there. So what would happen is the TRC, depending on the country, each country has a different tax year, and sometimes the language of the TRC is not very clear enough, which could help us understand what could be the tax rate to be applied. So that could be one challenge. The other challenge could be that it is a very small payment, and in spite of being a small payment, we still have to go through that entire complicated gamut of documentation to be made. And yes, it adds to the cost of compliance for the company, and it's actually having a consequent impact of delaying the entire process of payments. That's more about basically on the documentation part, which I can talk. That's on the TRCs, what could be happening. The other thing, what could be there is the next aspect on the compliances would be on the 15 CAs. Yes, the 15 CA CBs, yes, on one hand, yes, we had to take the certification, then do it on the portal. But with the changes in the tax portal, the issues continue. The vendors are not able to understand, make the payments to them on time. But exactly what happens is because of the revamp of the income tax portal, what would happen is we are not able to even do those 15 CAs. And the expectation of the tax authorities is after we do, they came up with a manual option. We do the manual option. Of course, payments are made to the bankers, but we have to keep track of all those payments that we have made. And subsequently, we have to still do them online. And when we try to do these things online, what happens is it actually, there's a lag of trying to submit. Sometimes it disappears. Those are all other issues of the new income tax portal, what we are facing. So yes, the companies, of course, the vendors, very frustrated, and especially MNCs, where most of our procurements are from foreign vendors, especially for licenses or any goods, whatever is there. So those are the challenges what I think we all companies, especially the MNCs, are facing here. That's my thoughts around it on the 15 CSCB and the TRC's perspective.
Yes, that's a tricky part. So, Deenal, your take on this.
Sure. So on TRCs, lot of complaints to make. So for let's say it's Mauritius, right? And government came up with a clarification that if just with the TRC, you can rely on the TRC and then consider that person, that entity to be tax resident and apply the treaty rates. But then again, once we do that, it's a favorite topic of the tax authorities to just keep on evaluating the substance of the Mauritian entity. So that then becomes difficult as to what to do. Second is for a lot of countries, they have started doing due diligences before issuing TRC. So they have started asking what is the transaction, what is the nature, quantum, contract copies. To an extent, they go. So it's really like they are also getting into the due diligence, and that also in a way defers the entire process of obtaining TRC. Third is there are countries which consistently, in spite of multiple follow-ups, they are delaying in issuing TRCs, and that becomes then difficult to deal with it. Then there are countries which have principles where they would not issue TRCs for a year until that year ends. So the only option that you are left with is to either rely on the most available recent available document, or then again take a kind of indemnification from the remittee. Unless it's a continuous contract and you trust the vendor, you may want to take a indemnification that eventually, if you're not able to give it to us, then you may have to bear the consequences, etc. And then lastly, the format of the TRC or the wordings used in the TRC may even not be convincing at times. So these are all the challenges which we face with TRCs while making remittances to the multiple countries. Now, in terms of 15 CACBs, yes, I would assume all the practitioners or participants also, everyone's wish was that this revamp of the portal would never have happened. Um, uh, I think Rekha already pointed out the glitches, but one of the critical point that we are at right now is that when there were portal glitches and the government clarified that, okay, you go ahead with the manual 15 CACBs. Now is the time to decide whether, we really want to do online filing of it, because once we do it, the portal will not allow us to put the date of remittance as a pass date, and then it shouldn't so happen that the department is treating this as a duplicate transaction, and doubles up the values and then ask for it is unnecessarily getting notices and explaining, which again is a costly affair, whether you consider it as internal cost or external cost in terms of consultants. That is a bit of it. There is some press release that has come in to clarify that yes, you can go in for the online filing of the forms, but still it's not completely clear as of now. So yes, these are the thoughts on the procedural aspects. Richa.
So thank you, Dinil, for sharing these issues with us. And I think my final question, since we are running out of time, is now to Rashmi. What are the key challenges on the procedure side that you face, and a few recommendations on how life of taxpayers could be made simpler?
So, Richa, Rekha and Dinal have covered it all. I really don't think I have anything to add per se on the 15 CACB requirement. Yeah.
So what about the lower withholding certificates? Have you encountered any challenges with that?
So yes, so this is another pain point you touched upon, Richa. So lower deduction certificate, the challenges we face are not more from a technical side, but they are more from a procedural side of it. One technical glitch which we have been facing is that when we apply it online, and then when you go to the assessing officer and say, assuming if your stars are aligned and the assessing officer has agreed for a 0%, right? But the portal does not allow a 0%. So the portal is, the minimum of, 0.1 is what, the portal gives. So, that kind of is a technical glitch. The other thing which we face from a procedure issue, Richa, is that, if we have to approach the assessing officer middle of the year, say assuming the LDC limit has exhausted, we don't see them really forthcoming, right? The other thing is, if you have previous years assessment orders, or you have demands, against your PAN or TAN, irrespective of the fact that you are fighting those out, right? And those are under protest, but still, those are taken as a benchmark, and that is where the negotiation starts. That why should this rate be given? You in any case have demands. Why not a higher rate, or altogether reject our application for a lower deduction or a no deduction certificate. So these are the challenges which we face, and I really hope that clear set of guidelines are given to the assessing officers also, for them also to be able to have have a set of guidelines to go with, and approach this LDC and NDC matter in a more pragmatic manner.
Thank you, Rashmi. This
Yeah.
is a very useful suggestion, I would say. And I think hearing all of you, it seems that yes, though because of these new developments, there are challenges, but the earlier challenges have not really gone away. So there is a lot of time in terms of the cost of, in terms of time and energy that goes on before any remittance can actually be made. So with this, I'll hand over to Jyotsna.
Thank you, Richa ma'am. Would you like to take up questions in the Q&A box?
I think we're, yeah, let me just see. Yeah, there's one question. I'll request Rashmi to take it up. So post the Telcom ruling, what is the panel advice on withholding tax on foreign remittances towards capital gain taxable under the Act but not under the treaty? Would you like to take that, Rashmi?
I think
Sorry,
Rashmi ma'am is not here.
I think she is logged off. I think to my mind, Pilcom ruling is relevant only in those cases where there is actually the rate which is given in the section itself. So capital gains, to my understanding, if I were to talk about the general capital gains, they would fall under 195, where this constraint is not there. So I don't really feel that ruling should come in the way of this particular situation. Of course, if you have anything specific relating to any particular type, then maybe you can just write to me, and then I can look at it further. So I think, Jyotsna, there are, I think, one or two more questions which are coming. Maybe I'll request you to just share those with me, and then we can revert back to them in the interest of time.
Sure. So thank you so much, Ms. Richa, for moderating the session, and thanks to all the eminent panelists, Ms. Rashmi, Ms. Deenal, Ms. Rekha, for sharing your valuable inputs. And last but not the least, on behalf of ASSOCHAM, I would like to extend my vote of thanks to all the eminent panelists who took time to be present here and share their valuable inputs, and also thanking the guests who have attended this conference and got benefited out of it. Thank you so much.
Thank you so much.
Thank you.
Thank you all.